So what's recession resistant? Mobile home parks historically have been recession resistant for a few factors you guys probably know because you're looking for them, of course, which most people are today. You got very low supply, right? Historically speaking, there hasn't been any new mobile home parks. They might even be going down in supply. So that asset class by itself is very unique. You can't really say that about really anything else except for maybe land, right? But land can be a little harder to produce income. Self-storage is unique. And so what I'm going through here is like each asset class has its own pros and cons, and there isn't one that's perfect.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How's it going, bud?
I'm good. I have no complaints, hanging in there. I was playing around with a deal we're working on, so got tied up, and then time flies. But no complaints. We're rolling.
Yeah, exactly. So we're a little late because of you, so we'll jump right into it. We're going to bring in today's guest, who I was just talking with before he hopped on. I think we're going to have a really great episode. I think we're going to have some good overlap on a lot of things we've spoken about and the things we've done. So I'm really excited to get into today's episode. So with that being said, Mark, thank you for joining us.
Thanks for having me, guys.
Yeah, absolutely. So kick us off. Tell us a little bit about you, your background, and what you do.
Sure, yeah. So I started kind of in corporate finance, doing budgets, planning, little auditing. It was early in my career. Like spreadsheets, like the math, the analysis. Didn't love corporate America. Didn't love climbing the ladder, 80,000 employee company. Transitioned a few years in to work for a small private retail distribution company. Did you guys ever collect baseball cards or Pokemon cards?
So I still have my cards somewhere. I've been meaning to dig them out because obviously they're like going like crazy, and I see so much stuff on social media of like, oh, this card's worth this much. And I'm like, damn, I got them pretty early on. I wonder if I've got any of those super rare ones. So I did the Pokemon stuff, but not like an avid collector of like I've got thousands stored.
Yeah, same. Not an avid collector. Have a couple.
Yeah, sure. So, and we all did, right? So, I mean, what the company I was working with was more on the mass retail side. So we would buy from Topps, from Upper Deck, from Pokemon, in mass quantities and distribute them to retail all over the country. Think about Walmart, and they have a whole trading card section in the store. And this was, so I'll give you some perspective on timing and kind of the size of the company. I came in pretty early. Revenues were around $5 million annually. Got the Walmart account, got a few other big accounts. Revenues jumped up to about $95 million by 2007.
Wow.
And so huge growth. I helped the company expand their operations to the West Coast. So we were distributing from upstate New York and from LA. So you could kind of have a little more efficiency, of course. But then Great Recession happened. Walmart basically said, get that stuff out of our store. We're going to replace it with staple items. Milk, bread, diapers, right? And I mean, the business just flipped upside down almost overnight. But along the way, finance, operations, experience, real estate was just, I was super attracted to it. So I started investing on the side. Personally, bought my first place. It was grandma's old condo. I moved into it, renovated it by going to Home Depot every day after work and talking to the guys that work there. Just learning by doing. Friends over, paint it, new flooring, you get it, right? So I dove in. That was actually an auction. So my first property was technically distressed, and I was just hooked, right? So I fast forward, I thought I was a genius. A couple years later, this is still pre-recession. The market values in the West Coast had skyrocketed. So I said, oh man, this is easy. Let me just pull some money out and go buy another one, right? And so I did that. I partnered with my brother. We bought a 4-unit in Hollywood. It was 75% vacant when we bought it. Needed a ton of work, and we overpaid. We just learned kind of hard lessons, right? It took 6 months to renovate 3 apartments, which should never happen.
Right.
and just kept going. But by the end of the recession, or I should say 2009, 2010, myself, I'd been partnering with my family members and buying primarily single family, foreclosures, REOs, short sales, a lot of distressed stuff, small multifamily. And we decided to partner and kind of grow and create our company by allowing other people that trusted us, knew us, liked us, knew our integrity, and bringing them on board as partners in our investment deals. So we, kind of became a real estate investment company with the purpose of doing more deals. So this is about 2009, 2010. And we kept doing a lot of single family, multifamily, buying distress, but we knew after a few years that, some of the greatest deals were probably behind us, right? They're deeply discounted, throw a dart at the wall, you can make money kind of deals. And so I started investing a little bit more passively into commercial real estate deals. I wanted more exposure to mobile home parks, right? Which I didn't know anything about operating, self-storage facilities, you name it. I've been invested in over a dozen different asset classes in real estate. And so we were doing a little bit of active and passive investing personally, and then also as a company, we syndicated a mobile home park deal. And then we just kept doing that. But by 2016, 17-ish, we started realizing, okay, the window's closing on deeply discounted, single family, distressed, huge upside kind of acquisitions. And we started focusing a little bit more on what we were seeing was what I would call more attractive risk-adjusted return in commercial real estate, in syndications, where we could partner with some of the best in the industry in their asset class and get really great returns and be able to diversify. And so we've essentially evolved over the years, guys, to initially an operator and now more of a private equity syndication firm.
Mm-hmm. Awesome. I love that. I think that's a really great journey. So what was it like early on, kind of, because I think everybody's curious about this, going into the more, taking on the investor's route and really starting into, buying bigger stuff for you?
Yeah, so early on, this is pre-Jobs Act, right? So we started raising capital before you could, do it online, and you had to have an established relationship with everybody. I mean, those were the laws, but that's also who we were working with, right? Friends, family, colleagues, coworkers. And so we did it the old-fashioned way to start. We invited everybody over to our house, and we gave them a business plan presentation in our basement, food, drinks. And we raised a little bit of money right there in that room just because people liked us. They trusted us. They knew our integrity. And they knew that we were going to work our butts off to make sure we did the best thing for them and their money. And it's just evolved over the years. Relationships take time to cultivate. You have to prove your credibility. You got to prove that you have a significant value add to them, especially in today's digital world. You can look up anything online, become an expert if you think in 30 minutes, right? So, and that's essentially how we've evolved. A lot of relationship building and a lot of investing.
I love that. I think that's good. And I do want to get into the topic of, branching out into other asset classes, because it's something we speak about a lot. John's been pushing us, or trying to push us, into the mobile home space for the last, almost 2 years now. What was like the wake up call for you, or what was like the trend, or, the frog in the boiling pot of water slowly over time? Like, when did you kind of look and say, all right, we've got to look at something else? Was it, you invested in a deal like, was it just that passive investment? Was it something else? Like, describe it for me.
Sure. Good question. So, I'll start it by saying this. Almost everything we do is from referral, from a colleague or another investor that has had positive success doing that thing. So my first syndication was in a mobile home park. I didn't just dive in and do it. I was referred to that opportunity by another investor who had already been invested in them. And so I got one-on-one education, and this colleague of mine who referred me over, a full-time passive investor for 15 years. So, I was listening. And when someone like that, with that caliber, I think currently has about 75 active investments, but they're all passive. He's a more of just an equity partner. I mean, that's his life, right? He doesn't have staff, and he doesn't have a whole team to manage and running operations. And so I mentioned that because the people are most important in our business. So when a referral comes from somebody that I trust and look up to, take it seriously. And mobile homes is how we got introduced to that asset class. So from there, it's a lot of analysis. Again, going back to my background, due diligence, doing a bunch of homework. It's a research paper. You got to study the asset class. You got to study how it moves, supply, demand, etc., and then get comfortable with it. And if you can get comfortable with it, that's great. And for me, it was a little bit of a no-brainer after learning about all the nuances in mobile home parks. And instead of going out and buying one and trying to operate it and going to these 6-month-long seminars and getting taught what I would say semi-boilerplate info, for me, it was just partner with the best out there and learn from them and keep going.
So was the strategy then to continue to invest passively until you felt comfortable to buy one yourself? Was it, strategic joint ventures? Was it raising money for other people? What path did you go down?
Depending on the asset class. So for mobile homes, we primarily form partnerships with highly experienced operating partners, which is another investment firm that focuses only on mobile home parks, for example. They've been doing it for a lot longer than all of us, and they've got a track record, that is very, very much the pedigree that we look for. Our goal is to access institutional quality commercial real estate. And a lot of the assets that we're investing in, purchase price could be $5 million up to $50-60 million. And so for individual investors, that's just hard. You got to be a very high net worth investor to get one, maybe two of those. But if you can find the right people, the right partners, and partner with them and invest in a slice of the equity on those deals and do that time and time and time again, that's really how we found to be the best model to scale and become very diversified, which is our goal.
So are you guys then primarily just bringing capital to the table for operating partners? Are you guys operating the deals yourself? Do you do just a bunch of different things as the opportunities see fit? What is your model that you're targeting?
Yeah, so we've evolved over the years with the markets, right? We started out as an operating partner. So we would source the deal. We would do everything from A to Z in-house. I had a team of property managers, contractors in multiple states, and we would buy, renovate, sell, refinance, hold, whatever the strategy might be, create portfolios of assets. But we slowed down on that, guys. Just honestly, I've found, again, going back to what I initially said, our thesis is more diversification and more scalability into what we feel to be better risk-adjusted returns. So again, we diversify across asset classes, we diversify across regions, we diversify across people, operating partners, and strategies. So to try and do all that in-house is just, it doesn't, we just don't think that's the right way to do it. We would rather find a specific company that does one thing very well, and they've been doing that very well for a long time, partner with them, and then do that time and time again.
Awesome.
What does that criteria look like? So for instance, you look at an operator, or you look at someone that does self-storage or someone that does this. What do you guys look for? Because I think a ton of people would get a ton of knowledge out of that, just understanding what makes them attractive.
Yeah, so first step for us is usually how do we hear about them, right? So I'm not online looking at I don't work with realtors, I don't work with brokers, I'm not on the MLS. It's really more of a network of savvy folks that have experience working with an operating partner, and then they'll refer them to us, and then we'll do some due diligence. So what that due diligence looks like, John, honestly, first of all, it takes a long time usually. It could take months, it could take years, literally to get to know people and feel comfortable investing with them and partnering with them. Some of the things we do to kind of, I guess, dissect that down, we have some kind of pre-qualifications, right? We've drawn a line in the sand on what we will typically invest in. and with whom. But we like to look for a pedigree, usually assets under management not less than 100 million. A lot of our operating partners are over 500 million. Some of them are top 20 largest operators in their asset class. Maybe they've been we like to see that they've been through multiple market cycles in that asset class. So for storage, I will usually like to see an operating partner that's been through 2008 and 9 and 10 and see how they did through that downturn. Mm-hmm. The reason why that's important to me is because we're at a market peak. We have been for a few years. And so the possibility of another downturn, anyone's guess, but timing wise, it's probable. Whether it's going to happen or not, I don't know. But if they've been through one before and they remained solvent and did well and continued to perform, that's a pretty big milestone to want to partner with somebody. So I'll say that it's AUM, it's experience, it's track record, and it's also strategy. What are they buying? What do they want to do? Do they want to just grow for the sake of growth? Or are they trying to really achieve long-term wealth? What is their strategy, right? Do they primarily focus on low cash flow and just all upside, or vice versa? Or how does it work, right? And so as far as returns go, we like to provide our investors with distributions from cash flow beginning in year one, typically 3 to 7%. We want to be able to grow that over the next few years through value add measures, raising rents, reducing expenses, and growing NOI, net operating income. That's the measure of success, is NOI growth. And then refinance out, get a portion of our principal off the table, reduce risk, keep our ownership, and continue to earn income and growth, and then eventually sell. And so that's usually what our business model looks like and the type of operators that we look for.
So because it was interesting, we were talking with 2 podcasts ago kind of about like the analysis and looking at like the micro of the rent rolls and the cap rates in the market or whatever versus like the macro of, the economy in the world. And, we just talked about, 08 and people getting crushed and, hotels and retail getting crushed now. How do you guys balance out, looking at the sponsor, looking at the deal, looking at the model, looking at the economy as a whole? And obviously, you guys are clearly diversifying because of what you see going on with the macro, and you have some reservations about it, I'll say, without putting words in your mouth. But how do you guys look at all of that when you're looking at opportunities, investing, and things like that?
Sure. I would say there's a multi-level approach. So again, going back to where are we historically? We're at a market peak. Okay, what continues to do well during downturns? And we've been saying this for a few years. And so what's recession resistant? Mobile home parks historically have been recession resistant for a few factors you guys probably know because you're looking for them, of course, which most people are today. You got very low supply, right? And historically speaking, there hasn't been any new mobile home parks. They might even be going down in supply. So that asset class by itself is very unique. You can't really say that about really anything else except for maybe land, right? But land can be a little harder to produce income. Self-storage is unique. And so what I'm going through here is like each asset class has its own pros and cons, and there isn't one that's perfect. Mm-hmm. Self-storage is very susceptible to new supply. So if you build one down the street, do you guys care if you're going to rent a 10 by 10 box to put your stuff in if it's brand new or 15, 20 years old? What are you looking at? You're looking at the price, right? Yeah. And so if a new one comes up down the road, it's going to affect the existing one very quickly. And so you got to be careful there. Apartments, same concept, right? If you're going into the nice stuff, call it Class A, right? Then you might be susceptible to new supply because that's typically what's being built today. If one's built down the road, they might be a little bit nicer, it might have taller ceilings and more features, amenities, and could be a very competitive rental rate for your resident base. Class B, Class C housing, slightly different, but then you might be dealing with more of a locality, right? Like what is the affordability of this? What is the demand? What is the user? What do they really want? Do they want just affordability or do they want amenities or kind of a mix of both? So location is also very important. I'll mention a few other points I think that might be helpful, but right now we're near the end of 2020 going into 2021, and we've seen that the pandemic has affected certain asset classes very negatively. Retail, hospitality, leisure, and other asset classes have done quite well. And so you're going to see, and we're already seeing it, a shift from investors that normally would be investing in office or retail. That's what they know and like and have been doing for a long time. They're going to move into what's a little bit safer, call it that. And what is that? I mean, those are the three I just mentioned. But the biggest supply of commercial real estate is in apartments. That's the one with the largest number of rentable square feet in the U.S. Mm-hmm. So you're going to see more people diving into apartments. We've already seen it. I mean, I've seen it for 5 months now, and it's just continuing because the future is bright. And maybe I'm going off on a tangent, Chris, so stop me if you
No, keep going. This is good.
Specific. Okay. But what we're seeing is things are evolving. They're constantly evolving. And for us, we're looking at 3 to 10 years down the road as to where do we think things are going to be. Really my job is to find a balance between risk and reward. You could have a very low risk investment, but you're going to get, mediocre returns. You could have a very high risk investment and have much higher returns. We like to be in the middle where we can feel very comfortable, sleep well at night, and not sacrifice too much on performance. Mm-hmm. And that's essentially what we do. It's a balancing act. It's looking at what's going on in the markets. It's looking at trends, opportunities, and kind of where we see medium to long-term demand for the asset class.
Gotcha. I think. Do you guys have any automatic no's right now? Just not, it could be the best deal in the world, but just not for us right now for a plethora of reasons.
Yeah, I say no a lot, John. I mean, we look at. Last time we calculated 10, 20 deals a month, and we invest in about 4 to 8 a year. And so we're very specific. I basically just cherry pick what I believe to be the deals that fit most perfectly in that sweet spot of risk and reward. So an immediate no for me right now, it's the 3 that aren't doing well and that we don't even have that much experience or desire to invest in prior to the pandemic, which is office, leisure, and retail.
Gotcha. I think that's interesting. So is there anything that, as you're looking, from probably a little bit of a different perspective than a lot of the people that we have on here, because I would say the vast majority are people that are doing their own deals or syndicating. They're not typically the equity partner in it. I think we've had maybe, a handful, 3 to 5 people in a similar situation. Do you think you look at things any differently than a lot of other people? Do you have different criteria, different metrics that you look at coming from that standpoint versus, let's say as the operator itself?
Yeah, I think first thing that comes to mind, Chris, is probably just conservative nature. And I'll tell you, when I'm underwriting a deal, I look at the pro forma, the financial model personally, and I decide after analyzing it pretty closely, is this a deal where I think we're going to be able to hit the projected returns and potentially beat them? Or does everything have to align, all the stars have to align just to get to the projected return? Mm-hmm. And that's a question you can ask your own, if you're doing your own deal, run your own sensitivity on your deal. What if your occupancy rate goes down 20%? What if your rents are flat for the next 3 years? What if you have a reduction in rent, right? And if you're looking at the debt equation, what if you got a 3-year loan, whatever it might be, a bridge loan? What happens if those situations arise and the debt comes due? This is how you can lose money. Let's just be frank. That's the scary part. You have people risk and you have debt risk. Mm-hmm. People is a broad risk, right? It's operational, it's trust, etc. But the debt risk as well. And so whether you're doing an active deal or you're analyzing someone else's, you got to run it 3-5 different ways to see if the outcome still is attractive, right? And so expense ratios, we look at those very closely. It's one of the reasons why we love mobile homes, one of the reasons why we love self-storage. They tend to have much lower expense ratios than apartments or single families, for sure. So there's a lot of different factors there, but at the end of the day, you got to be really comfortable because we're at an all-time high.
No, I think that's really important. I was talking to a buddy of mine who's offering on a deal, and we're talking about like rent comps and expenses. He's like, well, how do you know what rents are? I was like, I have no clue. I was like, unless I've got a deal that I'm doing it around the corner. I said, I have no clue. I said, unless you've got the exact property that you own, literally next door, that's doing exactly what you want to do, you have no idea. So what you have to do is come up with a range, pick a number that you feel comfortable with, run it at that, run it at the high end, run it at the low end, and then see how it works. And then, you run that with higher expenses, you run that with, lower income, and, you can go crazy running 40 different scenarios. Once you run you do the high rent, the low rent, you do the medium rent, then you do it with low expenses, high expenses, your scenarios, sometimes you pull the same levers, you get the same, or you pull different levers, you get the same outcome. So, you don't have to have 20 different things you're doing, but like you said, you want to run it through a couple different scenarios of what happens and just kind of try to understand of like, okay, if this happens, how does it look? If this happens, how does it look? And you just got to feel comfortable knowing that, hey, you're never going to know what's going to happen, right? The perfect deal would be if you had a crystal ball and you knew exactly what the income and expenses were going to be in 5 years, and you knew exactly what stuff is selling for. You could buy any deal. You just know exactly what number you need to offer at. You offer until you get one, and boom, you're done. But that's impossible. So I'm really happy you said that, because too many people, I think, just look at the numbers on paper and are like, okay, here's what it's going to be. I like it.
Can I add something to that? Because I think you're hitting a really good point. So a few pointers that I've just learned over the years that is an easy way to help with comps. One is find a couple property management companies, assuming it's not in your backyard, Chris, and you don't know the numbers, right?
Sure.
Find a couple property management companies that have been in that market for a long time. And I mean like 10 plus years. And they've seen what's gone on in the good times and the bad times. Find out if they know specifically that neighborhood, right? Within a mile or less. And you even want to get half a mile if you can, because you know how some markets are. They change in a couple streets. You're in the wrong side of town. And lean on them, right? Ask them a ton of questions and figure out what are they managing down the road? How's that been going, right? Whether it's a house, whether it's an apartment community, I don't care what the asset class is. You can do this by the old-fashioned way. Pick up the phone, start making calls and asking a bunch of questions, right? And start to get to know that market very well. The other source is realtors, right? They, again, find the guys or the gals that have been there for 20, 30 years, and they've been doing this for a long time. And they can tell you, and I've even had this back when we were more operational focused. I would literally buy online an old map, street by street of a county, and I would ask them to highlight exactly what streets I should be north, south, east, west of, and which to avoid, and they cross it out with a red pen, right? So that you literally can pinpoint your market, sub-market within a market to avoid the wrong areas and the wrong situation, and be able to fine-tune that market and your assumptions, of course, of rent rates and growth. And we do that on the commercial side. Like we've got an operating partner outside of Austin who partners with a local property management company that's got 12,000 apartments under management just in Austin. That is a lot of knowledge, right? You can simply ask them to a couple questions and you'll have a very good idea of what's going on the ground. So
yeah, no, that level of knowledge is huge, because even for us, we have in 2 markets, we have 700-800 units, which is helpful, but still a lot of our data we're getting from brokers, or looking at deals that are selling, or some other owners. It's good, but it's limited. It's not, if you had 2 deals in almost every submarket, you'd kind of know what's going on as you do rent comps, own your own properties, manage them. You'd have a really good feeling for what's going on. So yeah, that level of scale in an area is huge, and it's one of the things that, as I talk to people, try to as people of deals, try to help them out. But a lot of times I'll talk to people, like I remember talking to somebody who had a retail deal in Georgia. I was like, I don't own anything in Georgia. I've never looked in Georgia. I've never done retail. So like, I was like, start off the call. I was like, hey, I'm not going to have the answers for you, but I'll come up with the questions you need to get answered. And it's not always an easy conversation to have someone, because they're like, oh, what should I be doing? What should I be doing? I was like, go find someone in Georgia that owns retail and ask them these questions. Go on Bigger Pockets, go on Facebook, go on Google, ask an agent, ask a property manager, find somebody that does this in your area, and they'll tell you exactly what you need to know. He's asking like, oh, what do you think for rents? I don't know. What do you want to do? Throw a dart? Like, right. I'm just never going to know. I can look stuff up like you can, but you never know how real that is. Like, we were looking at a deal in Jacksonville, and it just went up crazy in price. And one of the reasons they're selling it on is a property down the road, which we also offered on and missed, has been jacking rents up like crazy. And it's the only one in the market to do it. It's still below Class A stuff, so there's still good delta. So it's possible that it could happen, but it's very recent. And because we're unsure, I have no idea if like they're actually achieving those rents. Are they offering crazy high concessions? Like exactly what they're doing. And it's really tough having even the knowledge that we have in that market for us to really understand what's going on, because I haven't been into the property. I haven't spoken to anybody. I don't live locally, so I can't just go drive by it and see it. Like, you rely on that stuff. And that's why having those local operators, people with that intimate knowledge, is so important.
Yeah, I'll say, lean on experts. Mm-hmm. We're lucky. We're in an industry. It's been around long enough. There's a lot of really good people in it. Mm-hmm. So lean on them. Okay. Number two, there are a couple of things you could do. Is you could mystery shop. Right? Have someone. I'm probably on Fiverr or another one of these websites. You can hire someone if it's got a leasing office, etc. Mm-hmm. At least to make a phone call. But you could go in person, and you see a lot of this on larger institutional quality apartments, and in quotes, pretend to be a potential tenant.
I do that.
Walk through the property. You do that, yeah. So you'll know if there's potential concessions. It takes time. You can't do that for every property listed, right? So sure. It'll just help you feel more comfortable, which is the goal at the end of the day, and make sure that your assumptions are sound.
Yeah,
that's I talk about all the time that you got to go through the process, right? Today everybody wants to press a button and have it done for them, and at the end of the day, you got to go through the motions at least a couple times, so you at least know if someone's doing it right or wrong. And that's the thing that most people want to. They ask the questions, hopefully to get those answers, so they feel like they don't have to do the work. But at the end of the day, you're going to have to go through that process, and then there's nothing better than physically doing it or physically speaking to the people that are doing it. But you still got to do it, and that's what most people try and avoid today. And that's, where a lot of these problems come up, is like, oh, well, I don't know. Well, go do it, and you'll probably figure it out.
Yeah, agreed.
So what are you guys looking for going forward? Obviously, we're in the middle of COVID. It's, the middle of November. We just had the election, positivity rates are going up, let's say, and, things are going to change on how they're handling it. How are you guys looking at things in the immediate future, and then, over the next, we'll call it 12 to 36 months?
Yeah. We have been essentially preparing for a market correction for over 2 years. And what I mean by that is we've been focusing our investment thesis on, if there is a market correction, what's going to continue to perform, kind of like we talked about a few minutes ago. And so for us, not a lot has changed as far as strategy goes. We're still investing in mobile homes and self-storage and Class B workforce apartments in affordable and growth markets. So we're double downing, if you want to call that, on housing, and we're also focusing heavily on self-storage, which has proven over market cycles to be quite resilient. So strategy, not too much has changed. We're saying no more than we were before. I want to be able to, again, look at a deal and just be really excited about it. Like, man, I cannot wait to be an owner in this deal, right? Mm-hmm. Because it is awesome. How do you get to that? Well, you got to have the right people, number one, operating on the ground. And number two, you got to have conservative projections that still hit the mark. And that's where a lot of them don't these days. we pass a lot on deals just have too much fluff built into them, and it's hard to figure that out if you haven't done this long enough. Like, is it really going to be an 18% return, or is it going to be 12, or is it going to be 8, or is it going to be 4, right? So, and that's where we help our investors out by just cherry picking the right ones. And looking forward, guys, honestly, like, people just need to be very careful. There's so much volatility right now. There's so much uncertainty. We don't know what's going to happen at occupancy rates if this virus and pandemic continues to skyrocket and if people start to lose even more jobs. So far, general mass trends seem to be a little bit more positive than they were several months ago. You got unemployment rate technically going down. You've got, I think, the most manufacturing jobs coming back on market in history in the last quarter or two. You're starting to see that, generally speaking, again, many folks are still working and still staying and paying when it comes to housing and real estate. I think those are the trends that we're hoping will continue. At the same time, if you flip the coin and you look at your exit strategy, which you always have to be looking at in real estate, you've got a ton of new investors come into the market that are scared of the stock market, that are leaving office, leaving retail, leaving hospitality, lodging, and looking and chasing yield and deals in these safer asset classes. So all that's happening right now, and it's not a time to, as John mentioned, I don't call it be lazy, right? You got to work even harder and even smarter than ever before to make it today. And that's something that you got to love it, guys. Like, if you're just going to dip a toe in this industry, like, now's not the time to dip a toe in, okay? It's just not. You're probably not going to, be very successful unless you're going pretty heavy and working your butt off. And so I would say keep doing that and persevere and align yourselves with the right people.
We talk about that.
Go ahead.
I was going to say, we talk about, what used to be 100 deals for one is now 200 or whatever it is. So if you're going to, underwrite a deal on the weekend and you want to buy a deal, now there's all different. If you want to buy a single family house, go for it. If you want to buy it's all return expectation. But even more so now is when you really got to get into it and understand it, because you're right. It's going to take a little bit more effort today than it did 6 months ago, let alone 2, 3, 4, 5, 10 years ago.
You said something interesting, and I'm curious if you have examples for it. You said, you see deals that have fluff to it. And I think for the person listening that doesn't invest passively in deals, but maybe doesn't have the sophistication or wherewithal to sit down, or even just the time to sit down and run deals through scenarios and have, hours to spend to really analyze a deal. Are there any things that you see in deals today that you're like, I think that's going to, I don't think that's right, or I think that's a poor assumption or something? Like, one of the things I think of potentially is really high income growth or rent growth organically, like 5, 6, 7%, which you sometimes see. Maybe that's something, or maybe if you see preferred equity in the capital stack. Are there certain things that you've seen that you're like, I think that's a little fluff?
Sure. For active investors that are looking on MLS or working with brokers, you got to be really careful of what those pro formas look like. A lot of them don't have vacancy rate built in. A lot of them may not have management fees built in. A lot of them may not have a lot of realistic expenses that are going to be incurred, like repairs and maintenance and maybe registration fees with the city, etc. So if you're looking at someone else's pro forma, start with those few points. Make sure those are built in. Now, if you're going to be holding for 2 to 10 years, you want to make sure your expenses are increasing as a rate of the income. It's not just flat, right? Like, property taxes is another big one. Usually when you acquire something, assuming that the previous owners had it for a little while, your property tax rate's going to go up. And I'll tell you, I look at broker deals, they just don't really pencil that in most of the time, right? So if you miss that alone is going to crush your cash flow. All of a sudden, you're going to be like, wait a second, I was expecting my property taxes to be X. This can't be right. Now it's Y. So you got to factor those things in and make sure you know how property taxes are assessed in that community, in that county, for that type of property, and when and how often. And can you appeal them, right? And so each county has a different appeal process. And so you have to really know that part of it. And then just more general, you mentioned something, Chris, that's important is rent growth. So it's very local, right? Like right now, New York City rents are going down 7+%. San Francisco's down 5.5% down, right? Who's penciling in a pro forma rent dropping, right? It just doesn't happen. So what's really safe is if you're not sure, assume your rents don't go up at all. Does it still pencil? Now, we're all probably going to do some value add. I mean, that's what we look at. We want to come in and renovate. We want to grow asset value. We want to be able to increase rents. You got to know that local market. What can you achieve in that market? And how do you know? We went through that, right? We talked about several ways to do that. And if you think you can get, let's call it 8%, guys, right? Go in conservative. Put it at 4. Higher. Be a little bit more have a little more padding on your deal today to help make sure that you're going to hit or beat expectations from the long haul. So those are a few points. We look at expense ratios a lot, and we look at like itemized expenses, payroll, admin, landscaping, snowplow if you're in colder climates. How can you consolidate? How can you save in those line items? Because it's not just about revenue growth, it's about cutting expenses too. What can you do operationally different than the previous owner to improve? Not banking on the market helping you. Like, what are you going to do differently, right? And that's where, John, you guys probably get it, but in mobile homes, it's a very mom and pop owned industry. And historically, if you look at a lot of these deals, they've been owned by mom and pop owners. They may not be as aggressive on revenue growth, or they may not be as creative on expense reduction. And so that's where opportunities lie. You could say, man, I could beat this all day long, right? Like, they're doing good, but we can do great. And we can make this property worth so much more without relying on the 7-8% appreciation, natural market appreciation. Where we can just rely on net operating income growth by pulling the right levers and working your tail off to improve that community.
That's the attractive thing. At least when the first one we looked at was in 2017. When we looked at it, it was the apartment is all value add pro forma. I had a deal sent to me the other day. It's like, I'm a conservative guy. I'm only growing rents at 3%. I'm like, that ain't fucking conservative. It's not. It's the it might be 0. So he was he pushed back, but I wasn't getting into it. The mobile home space, it's totally different. It's just a guy that's owned it for 30 years and he's got 3 vacant lots. Meanwhile, the demand is through the roof. I don't have to do anything here, just push a little bit harder or fill up a lot. And it's going to cost me nothing or maybe a renovation. And that's just instant value, no growth. It's just forced. And that's what the apartment world was 10 years, 15 years, 8 years ago, 6 years ago. Okay, I'll buy a 30% occupied property, make it be 70%. And it's worth more than what I paid for it. You still see that a lot more on the other side of the coin on the mobile home side, because you're dealing with not as a sophisticated group where they don't care. They've owned it for 40 years. All the tenants know each other. They pay, and this guy's mowing the lawn on Wednesdays. This guy's doing it on Tuesdays, and there's just no professionalism surrounding the situation. So where there's a ton of opportunity is just coming in and executing on that. You could see it a little bit more, and you don't have to go frothy on your rent bump, your renovation, and all that stuff. So you have a little bit of a, fat in there that you can protect yourself with.
Yeah, Mark, I think you touched on something super important on the tax side of things. And the other one I want to throw there is the insurance. I mean, right now, I don't know about you, but insurance is going up for everybody almost across the board. And anytime I see a broker deal, they, maybe rightfully so, because they don't want to give out tax advice, but they never pro forma out a tax increase. A lot of the areas we're in, taxes get reassessed upon sale. So, almost day one, we're going to get hit with an increase. And then 2, they're almost always using like 2 years ago cost of insurance. And you just sit there and you're like, this isn't realistic, and look, they don't have to be realistic right there. It's not, you're not buying on their advice. You've got to do your own stuff, but they're going to try to sell you on it. And I worry because sometimes people will say, oh, we use the pro forma in the book, or we spoke to one of our lenders. I think Ben said, a lot of times he just gets pro formas that they get from the broker book. And I'm just sitting there shaking my head. I was like, how can you ever, just fully rely on someone else's information when it would take 2 phone calls to figure out the true cost? Call your insurance guy, call whoever evaluates your taxes or the county, and just figure it out. I mean, it's 2 phone calls. It's 30 minutes of your time, and you would know right away. And then it's not like you have to make that same phone call every single time. If the deal's in the same area or the same market, that information for every deal going forward within a certain period of time, right? Because every year they might adjust how the taxes are done slightly. Insurance might fluctuate here and there, but you're going to be talking to them on an ongoing basis anyway. But those are, taxes is one of your most expensive line items, if not your most, and insurance isn't really cheap either. So, just that fact alone, definitely make sure you get your own information, do the little bit of work just to verify, even if you do think it's right. I think that's an awesome place to wrap up. I think people got a ton of stuff out of this. So Mark, thank you so much for doing this. If people want to get a hold of you, learn more about you, follow along, where can they do all that stuff?
Sure. Yeah. I would say our website's a great spot to start, smkcap.com. And, reach out, guys. I love this industry. I think there's a lot of amazing things that people are doing and can do. We're at a tricky time. So align yourselves with experts, even if it's just a local expert or if it's industry expert. Now is not the time to go alone into something that you aren't very well versed in. So we've got a lot of FAQs. We've got a lot of articles on our website that talk just educationally. I teach a local course at our community college just for fun, honestly, to give back about real estate investing. And there's a lot of content on our site. And then people can reach out direct if they have questions or want to learn more as well.
Awesome. Guys, definitely go check that out. I was checking out their website before we jumped on. It's got some great stuff, so definitely go do that. That was smkcap.com. And thank you so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Mark, once again, thank you so much for coming on. This was awesome.